Alright, dear students and scholars, now we are moving into the practice stage. This is where ASC 330 becomes a working answer, not just a rule we remember. In this video, we will solve multiple choice questions, short answer prompts, and one integrated case covering inventory cutoff, cost capitalization, cost flow methods, LIFO, NRV, gross profit method, journal entries, and reporting judgment. The goal is simple. When an inventory question appears in an exam, interview, audit file, or close process, you should know exactly where to start. Before we solve the questions, use these 5 gates. First, ask who controls the goods. That means checking shipping terms, consignment status, and transfer of control before year end. Second, ask what cost belongs in inventory. Normal acquisition and production costs are capitalized, while selling, abnormal, and most administrative costs are expensed. Third, identify the cost flow methods such as FIFO, LIFO, or weighted average. Fourth, ask whether valuation is below cost using NRV or LCM as required. Fifth, decide the entry or disclosure. Most wrong answers happen because learners jump to formulas before asking the ownership and valuation questions. Let us begin with MCQ 1 on cutoff. Delta Retail ordered goods costing $32,000. The supplier shipped the goods FOB shipping point on December 30th, 2026. Delta received the goods on January 3rd, 2027, and Delta closes its books on December 31st. What should Delta do? A. Include the goods in 2026 inventory. B. Exclude the goods until physical receipt. C. Record only a note disclosure. D. Include them only if already paid. Think through the shipping term and choose your answer now. The correct answer is A. Delta should include the goods in 2026 inventory because FOB shipping point transfers control when the carrier picks up the goods at the seller's location, and that happened before year end. B is wrong because physical receipt is not required when control transfers earlier under the shipping terms. C is wrong because this is not just a disclosure matter. The goods meet the recognition criteria at year end. D is wrong because payment timing does not determine inventory cutoff. The memory hook is this: cutoff follows control and shipping terms, not the warehouse door. Now, MCQ 2 tests capitalization. Which cost is normally included in merchandise inventory cost for goods purchased for resale? A. Sales commission paid to store staff. B. Freight in necessary to bring goods to the warehouse. C. Abnormal spoilage caused by avoidable damage. D. Advertising campaign for the goods. Do not think about whether the cost is related to the product generally. Think about whether the cost is necessary to bring the goods to their present condition and location. Choose your answer now. The correct answer is B. Freight in is capitalized because it is necessary to bring the goods to the warehouse and prepare them for sale. A is wrong because sales commissions are selling costs and are expensed as incurred. They happen after the goods are ready for sale. C is wrong because abnormal spoilage is an avoidable or unusual cost, and ASC 330 treats it as a period cost. D is wrong because advertising is a selling and marketing cost, even if the advertisement is for that specific product. The rule is capitalize costs needed to bring inventory to present condition and location. MCQ3 is a periodic COGS calculation. A company uses a periodic inventory system. Beginning inventory is $50,000. Purchases are $180,000. Purchase returns are $10,000. Freight in is $4,000. And ending inventory is $62,000. What is cost of goods sold? A. $158,000. B. $162,000. C. $172,000. D. $224,000. Work the periodic formula carefully and choose your answer now. The correct answer is B. $162,000. The calculation is beginning inventory of 50,000 plus purchases of 180,000 minus purchase returns of 10,000 plus freight in of 4,000 minus ending inventory of 62,000. That gives $162,000. A is wrong because it misses freight in or misstates part of the cost billed. C is wrong because it mishandles returns or ending inventory. D is wrong because $224,000 is goods available for sale before subtracting ending inventory. Periodic COGS is beginning inventory plus net purchases plus freight in minus ending inventory. Now MCQ 4 tests weighted average cost. A periodic system has 100 units at $10, then purchases 200 units at $13. The company sells 180 units. Which weighted average result is correct? A. COGS $1,800 and ending inventory $1,800. B. COGS $2,160 and ending inventory $1,440. C. COGS $2,340 and ending inventory $1,260. D. COGS $2,600 and ending inventory $1,000. Calculate the average rate first, then allocate it. The correct answer is B. Total cost is $3,600 made up of 100 units at $10 and 200 units at $13. Total units are 300, so the weighted average cost is $12 per unit. COGS is 180 units multiplied by $12, which equals $2,160. Ending inventory is 120 units multiplied by $12, which equals $1,440. A is wrong because it splits the total cost equally without using sold and ending units. C is not weighted average. D uses the latest $13 cost as if recent costs were all assigned first. Periodic weighted average calculates one rate for all goods available. MCQ 5 asks about rising prices. During a period of rising inventory purchase costs, which statement is generally correct under US GAAP cost flow assumptions? A. FIFO gives higher COGS and lower ending inventory than LIFO. B. FIFO gives lower COGS and higher ending inventory than LIFO. C. LIFO gives lower COGS and higher net income than FIFO. D. FIFO and LIFO always produce the same gross profit. Think about which cost layer goes to expense first when prices rise. Choose your answer now. The correct answer is B. In rising prices, FIFO sends older, lower cost units to COGS first and leaves newer, higher cost units in ending inventory. That means FIFO usually gives lower COGS, higher ending inventory, and higher income than LIFO. A is wrong because it reverses the FIFO result. C is wrong because LIFO sends newer, higher cost to COGS, usually producing higher COGS and lower income. D is wrong because FIFO and LIFO diverge when costs change. FIFO is balance sheet stronger in rising prices, while LIFO is more current cost matching oriented on the income statement. MCQ 6 covers LIFO liquidation. A LIFO company has a 2027 layer of 300 units at $14. In 2028, ending inventory falls and liquidates 200 units from that layer. Current cost is $16 per unit. What is the approximate pre-tax income effect of the liquidation? A. $400 lower pre-tax income. B. $200 lower pre-tax income. C. $400 higher pre-tax income. D. No income effect. Focus on the difference between the old layer cost and current cost. The correct answer is C. The liquidated layer cost is $14 per unit, while current cost is $16 per unit. The difference is $2 per unit. 200 units multiplied by $2 gives $400. Because the older lower cost layer flows into COGS instead of the higher current cost, COGS is lower by $400 and pre-tax income is higher by $400. A is wrong because the direction is reversed. B uses the wrong quantity or difference. D is wrong because LIFO liquidation affects income when layer costs differ from current costs. In rising prices, LIFO liquidation can create a temporary income boost. MCQ 7 test NRV. A FIFO inventory item has a cost of $54,000. Expected selling price is $60,000. Completion cost is $7,000 and disposal and transportation cost is $2,000. What write down is required under lower of cost and net realizable value? A 0, B $3,000, C $5,000, D $9,000. First calculate NRV, then compare it with cost. Lock your answer now. The correct answer is B $3,000. NRV equals expected selling price of $60,000 minus completion cost of $7,000 minus disposal and transportation cost of $2,000. That gives $51,000. The inventory cost is $54,000. So the write down is 54,000 minus 51,000, which equals $3,000. A is wrong because NRV is below cost. C is wrong because it likely omits one of the required deductions or uses the wrong comparison. D is wrong because it treats total deductions from selling price as the write down. The write down is the excess of cost over NRV, not the total selling costs. MCQ 8 uses the gross profit method. Beginning inventory is $75,000. Net purchases are $225,000. Sales are $400,000. The estimated gross profit rate is 40%. Using the gross profit method, what is estimated ending inventory? A $40,000, B $60,000, C $75,000, D $160,000. Convert the gross profit rate into a COGS rate before solving. The correct answer is B $60,000. Goods available equals beginning inventory of 75,000 plus net purchases of 225,000, giving $300,000. A gross profit rate of 40% means the COGS rate is 60%. Estimated COGS is 60% multiplied by sales of $400,000, which equals $240,000. Ending inventory is goods available of 300,000 minus estimated COGS of 240,000, giving $60,000. A applies the gross profit rate incorrectly. C leaves beginning inventory unchanged. D is estimated gross profit, not ending inventory. The gross profit method estimates inventory, but it does not replace annual physical evidence. Now let us move to short answer 1. Write your response to this prompt. Explain how inventory cutoff should be evaluated when goods are in transit, when goods are held on consignment, and when physical possession differs from ownership. Your answer should address control or ownership, shipping terms, consignment rules, and why location alone is not enough. In this type of answer, do not start with the count sheet. Start with the contract and the transfer terms. Write your response now. A strong answer would say that cutoff depends on control, not only location. Goods in transit are included by the party that controls them under the applicable shipping terms at the balance sheet date. Under FOB shipping point, control usually transfers to the buyer when the carrier takes possession at the seller's location, so the buyer includes the goods even if they have not arrived. Under FOB destination, control transfers only on delivery, so the seller retains inventory during transit. Consigned goods remain inventory of the consignor until sold to an end customer. The consignee may hold the goods physically, but physical possession alone does not transfer ownership. Start with the contract term, then test whether the entity controls the goods at year end. Short answer 2 asks about manufacturing cost classification. A manufacturer incurred direct materials, direct labor, factory rent, production supervision, abnormal spoilage, selling commissions, and general head office salary. Explain which costs enter inventory and which are period costs. Your answer should apply full absorption costing, separate production costs from selling and general administrative costs, identify abnormal spoilage as a period cost, and mention that fixed production overhead is allocated using normal capacity. Write your response now and remember, the production link is the deciding factor. A strong answer would say that inventory includes normal production costs only. Direct materials and direct labor are product costs and enter inventory. Factory rent and production supervision are production overhead and are also included, with fixed production overhead allocated using normal capacity. Abnormal spoilage is expensed as a period cost because it is not part of normal efficient production. Selling commissions are selling costs and are expensed as incurred. General head office salary is usually expensed unless it is clearly production related. The clean conclusion is inventory carries normal costs of production, not selling costs or abnormal waste. Short answer 3 focuses on the LIFO reserve. Explain what the LIFO reserve represents and how an increase in the reserve usually affects cost of goods sold and income. Your response should define the reserve, use the formula non LIFO inventory minus LIFO inventory, explain what a reserve increase means, and connect it to COGS and pre tax income. Write your response now. This is a favorite analysis point because it connects inventory measurement to comparability between companies. A strong answer would say that the LIFO reserve is the cumulative difference between inventory measured on a non LIFO basis, usually FIFO or average cost, and inventory reported under LIFO. The formula is LIFO reserve equals non LIFO inventory minus LIFO inventory. When the reserve increases, the LIFO entity is generally recognizing more cost in COGS than it would under a non LIFO method, especially during periods of rising costs. Higher COGS reduces gross profit and pre tax income. Analysts use the reserve to compare a LIFO company with companies using non LIFO methods. An increasing reserve normally means current period COGS increased relative to a non LIFO basis. Short answer 4 compares the retail inventory method with the gross profit method. Explain when each method is useful and one major limitation of each. Your answer should explain the retail method, the cost to retail ratio, the gross profit method, and the annual reporting limitation. This is not just a definition question. The examiner wants to see that you understand the evidence behind each estimate. Write your response now. A strong answer would say that both methods estimate inventory, but they use different evidence. The retail inventory method uses cost and retail records plus the cost to retail ratio to convert ending inventory at retail prices into an estimated cost amount. It is useful for retailers with high transaction volumes, but it can be distorted by mixed margins, markups, markdowns, and department or product mix. The gross profit method uses an expected gross profit rate to estimate COGS as a percentage of sales. then calculates ending inventory as goods available minus estimated COGS. It is useful for interim reporting, insurance claims, or analytical review, but it is not acceptable for annual financial reporting or tax inventory. Retail method is record based, gross profit method is margin based. Neither replaces an annual physical count. Now we have an integrated ASC 330 case for Crescent components at December 31st, 2028. Beginning inventory is $90,000. Purchases are $410,000. Purchase returns are $15,000. Freight in is $12,000. The physical count before adjustments is $122,000. There are inbound FOB shipping point goods of $18,000 that were not recorded or counted. Supplier consignment goods of $11,000 were included in the physical count. Company owned consignment goods of $9,000 are at a retailer and were not counted. The NRV of adjusted inventory is $130,000. The task is to compute adjusted ending inventory, COGS before write down, final inventory after write down, and the write down amount. Work through cutoff first, then valuation second. Start with the physical count of $122,000. Add the inbound FOB shipping point goods of $18,000 because Crescent controls them before year end. Remove supplier consignment goods of $11,000 because Crescent does not own them. Add company owned consignment goods at the retailer of $9,000 because Crescent still owns them. Adjusted inventory before valuation is $138,000. Now compute goods available. 90,000 plus 410,000 minus 15,000 plus 12,000 plus 18,000 equals $515,000. COGS before write down is 515,000 minus 138,000, which equals $377,000. Since NRV is $130,000, the write down is $8,000 and final inventory is $130,000. Now let us record the case entries and reporting effects. First, the unrecorded inbound FOB shipping point goods require an entry. Debit inventory $18,000 and credit accounts payable $18,000. This records goods Crescent controlled before year end but had not entered into the books. Second, the NRV write down is debit loss on inventory write down $8,000 and credit inventory or a valuation allowance $8,000. Supplier consignment goods are removed from the count because Crescent does not own them, so that is a count correction, not a purchase entry. Company owned consignment goods are added to inventory evidence because Crescent still owns them. Final ending inventory is $130,000. If the write down is presented inside COGS, total COGS effect is $377,000 plus $8,000, which equals $385,000. The order matters. Cutoff first, valuation second, presentation last. Let us close the practice session with what strong answers had in common. First, start with ownership and cutoff because every inventory question begins with who controls the goods at year end. Second, capitalize normal acquisition and production costs but expense selling, abnormal, and most administrative costs. Third, apply the correct cost flow method consistently. Fourth, watch LIFO layer effects because liquidations can create temporary income effects. Fifth, use the correct valuation model such as lower of cost and NRV for FIFO and average cost inventory. Sixth, separate estimates from annual evidence because gross profit and retail methods do not replace a physical count for annual reporting. Next, we move to revision controls and the IFRS bridge for ASC 330. If this practice helped you build confidence, please like the video, subscribe to the channel, support the course, and share it with colleagues who are learning US GAAP. I will see you in the final ASC 330 revision lesson.